You know, Andy, hang on a second, because we've also got Bill O'Donnell here over at RBS Securities. He's the managing director and head of U.S. Treasury strategy over at RBS. Bill, you've gotten some of the initial headlines on today's auction. What do you think so far?
I think that's a promising start. A few weeks ago, we had another series of auctions, and then last week we had a break. And 2 weeks ago, we saw significant foreign demand for all of the Treasury securities that were bought that particular week. And what we're particularly interested in is to see if this kind of demand would resurface for this week's auctions, because the pot of gold for the Treasury market remains Thursday. And once we get past the 30-year auction, we're going to have slightly more than 2 weeks without a coupon auction. And I think that's going to the Treasury market will breathe a sigh of relief.
I mean, it is tremendous when you consider the amount of supply coming on week after week. It's kind of interesting to still see that there is demand out there.
Well, there certainly is, especially now that the stock markets, at least the technical conditions in the stock market, NASDAQ, S&P 500, even commodities starting to weaken. We're starting to see risk assets, which have really outperformed over the last 3 months, start to wobble. And that, I think, has kept or even brought back some money to the Treasury market, which is what we saw in auction 2 weeks ago and apparently with the TIPS auction today.
Bill, talk to me a little bit, too, about how significant it is, because we've got 4 auctions going on this week, $73 billion in total. As you mentioned, we end with that 30-year auction on Thursday. This is the first time that the Treasury has done this since they began selling securities regularly back in 1976. So we don't see this often. How does that either help or hinder potentially the Treasury trade?
Well, it's certainly a headwind. I mean, you can't deny it. The Treasury is raising roughly $59 billion of net new cash this week. I might add that's somewhat less than what the Treasury raised 2 weeks ago in net new cash. You need to have continued inflows, and that's exactly why we're watching foreign investor demand. Foreign investors hold roughly 50% of all outstanding treasuries, and we need them to participate in order to keep rate levels capped.
Right. All right,
and that's happened so far.
Carol, I got a new statistic for you. We were just, Brian Luke, who's joined us on the markets team as a bond market reporter, ran the stats. You know, the indirect bidders were, again, the most competitive, Carol, and it really shows, to Bill's point, how much demand there is from foreign central banks that want to own these. But I guess the conundrum that, Carol, that you and I keep wondering about, and maybe Bill has an answer for this, is why all of this demand, especially for things like 10-year and 30-year bonds, which everyone keeps saying inflation is going to go up. You'd have to be silly to lend the U.S. government, money at 4%, 5%, 3%, and yet we still see all the strong demand. How do I rectify those two things?
Well, I'll tell you what, the way to rectify the demand is to sort of step away from the market on a day-to-day and week-to-week basis and look at what's transpired in the global economy over the last year to year and a half. Conditions have changed. We just really put an end to 20 to 25 years of profligate lending, profligate spending, and it's going to take more than a year to return to taking on risk assets, taking down new debt. Consumers still need less debt. Consumer savings rate has been going up, is likely to stay up and maybe even go higher. And in those kind of conditions, these are fertile conditions for a continued improvement in the Treasury market.
Bill, hold on. I'm sorry. Go ahead, Andy.
Well, does that mean that the money that was going to, say, asset-backed bonds like credit card receivables or auto loans, is that money now going back into the Treasury market? Is that what you're trying to tell us?
Yes, and it has been in the Treasury market for the better part of 6 to 8 months, where it started flooding in the fourth quarter, really post-Lehman of last year. And, of course, during the months of May and June, we saw a flight out of Treasuries and back into risky assets, and that's when 10-year yields went up toward 4%, having touched 2.5% in the middle of March. But I think people are now beginning to question whether slightly less negative economic data is going to be enough to force inflation up. We think that's a legitimate question, and therefore, as long as that question is being asked, we think the money is going to stay in the Treasury market as opposed to flowing into risk assets.
Bill, let me ask you, in terms of strategy and where, you should be either taking on risk or not, when it comes to the Treasury market, investors have found they can make a lot of money elsewhere, certainly more than they can in the Treasury market. What is the right strategy play when it comes to Treasuries, in your view, at this point, or is there one?
Well, you're asking a Treasury strategist, so I'm going to give you a biased opinion. We very much like the Treasury market. We've basically been in a range. Let's just use 10-year yields, our benchmark 10-year yields as a guide, of 2.5% to 4% for the last 3 to 4 months. I think 4% is extraordinarily cheap. I think the inflation prospects in this country are going to remain diminished or non-existent for the better part of the next 12 to 24 months at least. There are just still too many excesses and imbalances in terms of too much debt, too much spending, higher unemployment going up every single month. In these kind of conditions, I just think that the prospects of inflation are diminished. Therefore, the prospects for the Treasury market, riskless assets, I think are very good.
Bill, how do you judge inflation? What is your favorite metric for doing that?
I think you have to look at what the Fed's looking at, core PCE prices or core CPI. That's what they watch, so that's what I watch.
Hey, Bill, just got 30 seconds left here. We just had the list of the rest of the auctions. You've got 30 years on Thursday, you've got 10 years on Wednesday, and tomorrow you've got 3-year notes. Anything that happened today in terms of the auction, does that give you any indication about the rest of the week? And just quickly.
I don't think it gives us any indication, just because TIPS investors tend to be, sort of stay in that domicile. I wouldn't call them a derivative product per se because they're Treasury issued. But I do think that the indirect bidders is a positive, and I hope to see that with 3s, 10s, and bonds later on this week.
All right. Got it. Bill, thank you so much. Bill O'Donnell over at RBS Securities and our own Andy Cinco down at the markets desk.